Hi, my name is Nicole, and today I would like to welcome you to the Real Estate Podcast on the Travel to Money channel. I'm here with my co-host, Jeremy Resmer, and today we are going to be talking about the pitfalls of buying houses and how to avoid them. So, hey, Jeremy, how you doing today?
I'm doing awesome. How are you?
I'm great. Well, I'm really excited about this topic because I think it can be helpful for a lot of people to know just what to look for, whether they're buying their first home or whether they're getting into investing in real estate in some bigger way. I would imagine you've seen the gamut of things that have happened when buying houses. So can you tell us what are some of the worst mistakes you can make when looking to purchase a house?
Yeah, good question. So I've made a few mistakes in my day. I made a lot of mistakes, still making mistakes. But I would say that one of the big ones, and this is easy, is just overpaying for a property. I see people all the time. They're like, "Oh, this is a deal," and I'm like, "Okay, talk me through the numbers, right?" And they'll say, what the property is what they can get it for. They'll give me their renovation numbers. And so depending if they're going to flip it or they're going to keep it as a rental, your numbers are everything, right? And so I see people all the time not getting their numbers right, or they don't necessarily take into account all the different potential costs involved in buying a house. And so it might look good if you just take the bare bones, hey, this looks good at this price. However, you've got property insurance, you've got property taxes, you may have personal property taxes. If you're not a state entity, you may have additional taxes, repairs and maintenance, right? HOA fees. Dude, HOA fees have killed me this year. I've paid on one property, I've paid $3,000 in special assessments.
What?
Now I couldn't control that. It's a special assessment. I've owned the property for a couple of years, but there's all these little things that kind of add up, right? So overpaying for a property and not taking into account all the expenses those are two that are at the forefront. I see it all the time.
Yeah, I would imagine there's a lot of people like me out there who we get excited about something and actually are trying to justify it through the numbers and not really being honest with ourselves. I know I have done things like that. And so I could see that easily happening if you are an impulse buyer at all, or you're getting excited about something and you're not really making it just truly about what the real numbers are, or maybe not doing the research on what's involved in that. I know that in the process of looking at a house, you may have an inspection done. You're looking for different things physically on the house. What are the most expensive problems to look out for when you're inspecting a house?
So I would say, if you've got foundation issues, cracks or settling or things that appear to be settling that could actually be a major foundation issue, or the house is actually moving apart from itself. Those are really expensive. And again, it really depends on the individual, right? Because if you're a contractor, then you can probably fix that yourself a little bit cheaper, or a lot cheaper than calling out like a Ramjack or one of these nationwide companies that fix foundations. You might be able to do it for $5,000. You might have to pay $20,000 if you call one of these other companies, right? So depending on if you have any contracting experience, that's one thing that is going to weigh into that. A lot of times if you're not paying much attention or you don't really know, you want to look out for soft floors, right? Particularly around dishwashers, refrigerators, bathrooms, because you might have soft floors, which indicate maybe there's a leak, or maybe there's something going on underneath the tub or shower. And so you don't know how long that may have been going on for. So what does that mean? Well, if your floors are soft, your subfloor might be rotted out. And beyond that, which becomes a bigger issue, is if your subfloor is rotted out, if that's been going on, or if there's some leak beneath even the subfloor underneath, then now you might have floor joists that are rotted out or failing that have to be replaced. And that can get really expensive, because now you're talking about tearing out all the flooring, opening up everything, and having to sometimes have to, jack up the property or do things underneath the house that just gets really expensive, and it's a slow process. So, that's a big one. What else is a big ticket item? Your mechanicals, right? So your HVAC, that one is a biggie. And again, all of these things have only gotten more expensive since COVID happened and all the inflation and all of that. Some of these things you used to be able to do for, a third or half the price. So in HVAC, like at my house, I think I replaced my HVAC in like right in the beginning of 2020 or 2019. And I think we paid like, I don't know, I want to say $5,500. Now it's $8,000. So that's a big ticket item. And then of course your roof too. That's a biggie as well.
Yeah.
So you want to look for any type of leaks, any
Right.
type of damage, the sheathing, any of that stuff. If that's rotted out, that could be a big problem too. So I would say those are kind of your main big ticket items.
Yeah, for sure. It's foundation, roof, HVAC. That makes a lot of sense. Did I tell you that I replaced my roof in Spain? That was the big ticket on this new house. We knew that there needed to be a new roof because it had caved in. And we did the roof it's like the long sheets that you lay down, used to be done on industrial, but now they make them look like the clay tiles or whatever. And we did the whole roof for about $3,000, including installation. So that felt pretty good because I know it'd be a lot more in the US. So just one of the benefits of doing some stuff in Spain, things tend to be a little less expensive, but I still have been caught off guard in a couple of situations. So in everything that you've seen, because you've done flips, turned houses into rentals, have you ever walked away from a deal due to red flags that have come up, like something that you were pretty invested in already or anything like that you've seen?
Yeah. So one of the things when we put our house under contract, typically, unless it's a smoking deal, unless we know like, hey, this is a really, really good deal, no matter what's going on, we're buying this thing. That's usually not the case. Usually we'll have a due diligence period. So when I first started out, I would always do inspections on a house. I wanted to know, I'd get an experienced inspector. So this is maybe a tip that could be helpful to people, because a lot of times people think that just because someone is an inspector, they know what they're doing. Just like anything else, you get a lot of people that don't know what they're doing, even inspectors, even if they're licensed. So hopefully, if you have a choice and you're going to go that route and have an inspector, go find someone that works with investors or maybe is an investor themselves. Because having someone with experience and knowledge, they might be able to say, hey, on a retail property, here's what you're up against. But on an investment property, they're going to look at it and hopefully keep you out of danger. And, you could tell them, hey, go look at these things specifically. I mean, you can have that dialogue what you want because this is an inspection for you. So I'm at a point now where I've seen so many houses. I've done so many of these that I pretty much, even if I don't have a licensed contractor or someone that really knows what they're doing, like I've done so many of these that I know what to look for. And so I don't go and do this anymore. But for my first probably year in real estate, I always did because I didn't want to, get myself into a jam and miss something that was avoidable. So, it's good to have an inspector. It's good to have your GC or your contractor who is, able to walk the property and also look for specific things, because your GC is going to know all the costs. He's going to say, hey, here's the way, there's two options to fix this problem. And he's going to say, this option, here's your risk, here's your cost. The other one might be, a easier fix. It may not be a better long-term, but there's going to be different options and there's going to be different costs associated with that. So certainly you're going to want to make sure that you have those two people on your team who can help you properly evaluate the condition of a home, any potential issues, and then what the costs to repair that are going to be. So, that's a big piece of the puzzle to help avoid some of those pitfalls.
Okay, and question about inspectors. I just learned recently in Spain, they have someone who comes and does a general inspection, but there's some kind of inspection that you can pay a little bit more for where they're doing more of a structural inspection along with it. Any inspection I've had in the US, it's just like your one inspector. Do they have specialists for certain things? Is there a situation where you might want to hire someone that's more experienced in a certain area?
Yeah, so typically the way it works here, what I've always seen is, again, that inspector, it doesn't mean that they're a licensed contractor. It doesn't mean that they know exactly how to fix it. They're just identifying, hey, for example, there's a crack in the foundation. So what they will do is recommend that a licensed contractor or a structural engineer come out to evaluate. And the structural engineer will come out. I mean, shoot, I don't know what you're going to pay now, probably $400 to $600, I would guess. And your structural engineer is going to take a look at the house, make sure that everything is structurally in a good, is good or not good. And then they will give you a report telling you, what either needs to be fixed or, hey, this is not okay, this has to be addressed. So there is that specialization, and that's going to be your structural engineer who will take care of that for you.
So, what are some tools that can be used to avoid pitfalls? Anything other than hiring those two people? Anything and this is not necessarily just on the physical state of the house, but just in order to avoid pitfalls in general, what are some resources or tools that people can use?
Oh, that's a good question. So, I think the biggest thing, we kind of hit on it, honestly. So if you're gonna put a property under contract, and I didn't fully answer your question, so I want to go back to the other question and give you an actual answer. But you want to have a due diligence period. You want to make sure that you can get your people in and have a look and get eyes on, the mechanicals, the HVAC, the roof, the things we talked about, right? The foundation. And so that's where, again, your inspector is going to be a huge asset to you. And then also your general contractor is going to be a huge asset to you. And so what I always tell people is, listen, go through the house. Don't have your general contractor leave and then work up a budget, because he may forget. But if you actually are going through with him, like there's tools online that general contractors have, where they can literally have all the different things. They will go and look at like your HVAC, and they'll put, what they see, roof. And then, so you're actually walking the house with them, talking through what you're going to do. Hey, we're going to remove the carpet. We've got a, foundation issue. We got to, correct this. That's cost is involved. Then once we do that, we'll have to replace the subfloor. And then we're going to come back with, LVP. So when you're doing that and walking them through what you envision doing, now all of a sudden your costs are being worked up right then and there. So at the end of that inspection or that walkthrough, what it's going to cost, and you don't have to go back to the general contractor and say, hey, can you get that to me in a couple of days, because it might be a week or whatever, and then things are missed, or I forgot about that, or you know what I mean. So you want to be as accurate as possible, and so that's a really good way to do that. It's not really any additional tools, it's just a good process and a good habit, and doing that. And if your GC has those tools, then obviously they can get that to you right away. To me, that's key. And then you asked me earlier, and I didn't answer your question. I got distracted, but you asked me about, are there any deals that I found red flags and backed out of? So this was early on here in Tennessee. There was a really cool house, big property. It was a log cabin and really good area. It could have been an Airbnb. That's what I was thinking, or maybe a flip. Well, I actually got to the property and had my inspector come, and there were a couple things I noticed. There was a huge wave in the floor, actually sag in the floor. So I knew there was a foundation issue, and the guy tried to kind of cover it up with a rug. I don't know if that's just the position of the rug or he was trying to cover it up, but it was so bad that, you couldn't miss it. And we talked about it. And so that was one thing I noticed. And then I had my inspector, who actually, by doing the inspection, came in and said, hey, I just want you to know there's a really serious situation here. There was fire damage, and that needs to be remediated, because even though the fire damage, you can't see it, it's actually there, and here's your risk. So there was number two. Number three is, with the log cabin, it requires a lot of maintenance, and the wood wasn't properly maintained. And he basically told me, he's like, look, based on what you have to do to get this up to where it needs to be, he's like, you've got wood bees that tunneled through all over the house, literally all over. He's like, you're going to have to fix all that. You may have to replace, all of the wood. He's like, you're talking about just for this right here, this job. He's like, I'm looking at it easy $80,000 to manage these three things. And so I went through with him, and I'm like, holy cow, like that killed the deal right there. So again, having someone that you can trust, that knows what they're doing, that has flipped houses before, has done the renovations, has done that type of work, and essentially is my eyes and ears, like they're going to save you money a lot. And so it's better to not buy a deal than buy a bad deal. And so a lot of times people are like anxious, like, oh, I got to get this deal. It's such a good deal. And you think that, maybe you're overexcited, or the thrill of the chase, or you just have to close on something. But I want to assure your listeners that no deal is way, way better than a bad deal. I've gotten myself into a couple of bad deals because I'm like, oh, this is, someone else told me it was great, or, hey, it would sell for this. And, you get into it and you're like, oh man, this 2 hours worth of work is actually 2 weeks worth of work. Why didn't you tell me? I just bought it sight unseen. And so my guys come here and they're looking at the house. They're get on the phone with me. They're like, hey, are we at the right house? I'm like, yeah, I think so. And I walk in, I'm like, dude, what is going on? My agent said this is 2 hours worth of work. And they're like, no, it's 2 weeks. And we're looking at $20,000 worth of work where I thought it was going to be like maybe 2,000 max. Right. So, and then come to find out, like there were other things in the house where it was like, well, we need to roll these walls here. Like you told me this is ready to go. This isn't ready to go. And so I learned my lesson. Like I can't always trust what, other people are telling me. So, I've come a long way since then, and we buy a lot of houses sight unseen, but it's always good, especially when you're starting out. I would say your first 10 houses, go get the inspection with somebody that knows what they're doing. Go walk it with your contractor. Understand the costs involved, understand the problems, because now you'll start to know what to look for and you'll start to know these things. And so that's only going to make you a better investor. And it's going to make you more money and save you from all of the money that's going out of your pocket.
So I have kind of a last question about how you look at a property and figure out the numbers. In my mind, I'm picturing two resources, like some sort of checklist that's like, these are all the questions that we ask about a house. Things like you mentioned in the beginning, like HOA and different things. Do you have some sort of list or resource that you use to make sure there's nothing missed when you're kind of doing that evaluation phase?
So at this point, it depends what I'm going to do with the property. Okay. Mm-hmm. So if I'm going to flip the property, I just work all the numbers right up in my head. I mean, it's really simple. If I know that if I'm going to flip a property and I'm like, sometimes I say I need to make 30% return on my money. Now, is that 30% gross or net? That depends on the property. It depends on the amount. But, if I'm flipping a property and I can make $100,000, that might only be 20% if it's a higher end house. But if I know, hey, there's a lot of margin on this, or hey, we know our cost and making that 100,000 might be worth it. So I might do 20% instead of 30. Maybe it's a house that doesn't require a lot of work. We can get it in and out. We're going to paint. We're going to replace the flooring, maybe upgrade countertops, paint the cabinets, whatever. Something where we're in and out for $5,000 to $15,000, $20,000. And if we can make a quick $30,000 rip, what I'm looking at is very simple. I'm looking at the sold comps. So usually what we're looking at is trying to go to the top end of the neighborhood or maybe one step above. We don't always do that, but that's kind of our general rule. If we're doing a full flip, then we want to go one step above because we feel like we can beat those comps. We beat them every time. Now, I say that and not with an arrogance. I say that when there's stability in the market, right? So if all of a sudden prices are dropping or there's something crazy happening, well, that's a different story. You can't control that. So you have to be careful, right? But if you're in a time where things are pretty stable and you either you want to flip to the quality of the neighborhood. And we like to go one step above, just above, so that, maybe there's some, really cool accent wall, or maybe there's some really cool feature and we want to make that pop, or maybe we want the kitchens and bathrooms to pop. We might take it the next step up. But I'm looking for this, the sold comps. And I just need to make sure that my numbers work. So every flipper I know is different. I've got guys that are doing 20 properties at once. And they're like, hey, if I make $10,000 or $15,000, I got to keep my guys busy moving from project to project. I do not operate that way. I think that's crazy. So what I'm looking for, if we're going to flip a property, my preference is I want to do something that's an easy cosmetic flip that we can get in and out. We're not going to be stuck holding this for a long time. We're not going to pay all these additional fees. And so I like to make, honestly, I like to make $50,000 to $80,000. That's kind of a sweet spot. And there's ways to do that if you evaluate on the front end and you negotiate well. I think they say right now, average flips are somewhere in the $60,000 range. So depends on what market you're in. If you're in a smaller market, you might be getting 20 to 25,000 when it's all said and done. But if you're in a bigger market where spreads are a little bit bigger, or if you're in California, New York, I mean, you can make $200,000 off of a flip. So it really just depends. It's a lot of it's going to be market specific, and it's going to be, where you're located. It's going to be what your goals are and what your required returns are. So, but those are some of the things that I'm looking at for a flip. For a rental property, it's actually really straightforward. I just say, hey, I want to get 1% of, I want to get 1.5% of the rent. So if I had to do the math here, it would look like this. So I'm in a small cash flowing market. If I can rent a property for $1,000 here's what my offer is going to be. This is fantastic. It's so easy. So it'd be $1,000. That's what my rent's going to be after this property is renovated. I'm going to divide it by 0.015. So that means that I'm going to offer, if you could read that, 66,000. However, if I have to put 10,000 in, I'm going to minus the 10,000. So my offer is now 56,666, blah, 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 blah. So that's how I do it. Now, in certain markets, you're not going to get 1.5%. You might only get 1.2%, 1.3. But my rule is in the bigger markets, I have to be at 1.3%. And so it's really simple. It just means that whatever the rent will be, okay, if I can get 1,500 divided by 0.013 equals my offer less my renovations. So if it needs nothing, that's my offer. If it needs 10,000, I minus the 10. If it needs 20. So you're just going to adjust it to what your required rate of return is. And I guarantee you that my rate of return, if I can get 0.13 or 1.3 or 1.5, I will have both equity in that house and I will have cash flow. So I'm trying to get into investments that I'm not losing money. Like I don't do this to, for charity, right?
Yeah.
I'm trying to make money. So that's kind of how we protect ourselves. So flip is one thing. There's some criteria that we use. And then for rental, it's a totally different set of criteria. So we're just looking at it, several different ways to make sure, hey, do we really have a deal? And what's the best use of this property for us to meet our buy box?
That's awesome. I really love that you took the calculator out and just broke that down, because you've mentioned 1.5% before. And I'm like, I'm not sure where that is, like where the numbers are. So I really love that. And maybe we'll make some sort of resource or something to put up on the site so that folks can have access to that really easily.
Can I show you an example of why this is important?
Yeah. Love it.
So here's the very first house I ever bought. So it's in Clarksville, Tennessee. The property, it was renting for $850. Okay. And I know a lot of investors who are like, hey, if you can do 1%, that's great. So $850, and this was not renovated. It was in good condition, but $850, if I would have divided that by 0.01, I would have offered 85,000. So if I do my numbers, what did I say it was? It was 850 divided by 0.013. That was so that comes out to $65,000. So 86 versus 65. Now, here's the thing. Right. And so what I actually was able to do is I knew after taking my property manager there, I was able to quickly go in. He said, hey, realistically, like this place being a 4-bed, 2-bath, it should be able to rent for $1,200. But he's like, this tenant wants to stay there. We're not going to go jack up the prices. And so let's make sure we have a game plan. So I kind of took that into consideration and I bought that property. I ended up having to put in about $400. That's it, $400. And I had a tenant live there for 4 years.
Oh my gosh.
I bought that property for $77,000. The seller was thrilled to sell it for me, to me at that price. Today, that place rents out for $1,450 4 years later. It's valued. Now, keep in mind, it's not always going to work like this, right? Because we had COVID, we had all the inflation, we had all the things happen.
Sure. Rent
but that house
everywhere.
Yeah. That house today is worth $200,000. And I've only owned it for, since 2019. So about 4 years, a little under.
That's pretty wild. That's really cool, though.
So that's the thing, though. But if you look at it, people are like, oh, what's the difference between 1.3 and 1.0? The difference is $21,000. And so by buying it with that extra $21,000 cushion, number one, it means people are going to tell you no more often. But I would rather have people tell me no, and I buy the right assets where I know I've got cash flow and equity from day one. We're not doing this to give up money. We're doing this to build wealth, long-term wealth, and that's how you do it.
That's fantastic. I feel like so many people are afraid of math. Like there's an actual phobia of math, and a lot of people seem to have it. It's like they'll be sitting with a salesperson buying a house or buying a car, and they don't realize that those small differences in the interest rate make a huge difference in what they have in the long run. And so I think this is another example that explains that what sounds like a little number can make a really big difference, and can really protect you. And I guess you could probably say someone that would pay the 1% or just be looking to get the 1%, it's still not necessarily a bad deal, but there are better deals, I think is what you're saying, right? Like,
here's my concern with that. So
mm-hmm.
in a up market, so if somebody would have bought, if I bought this at 1%, I still would have made out like a bandit because we had an up market, we had inflation, we had all these things take place. So that would have worked out. But one of the things when I buy a rental property specifically, I never buy for appreciation. Appreciation's like the frosting on the cake, right? I don't buy for that. I buy for equity. I buy for cash flow. I buy for depreciation, and I buy for amortization, meaning paying down the mortgage balance, right? The principal. So if I get those four things, I'm a winner. Seriously, I'm a winner if I get those four things. Now, the bonus here is like literally the frosting is appreciation. So in this case, I got the frosting, and that 1% would have got it. But let's take it the opposite direction. What happens in a down market? If you pay that extra $21,000 for that house and the value of the house goes down, guess what? I'm still in the money. I can still, if I had to liquidate that asset, or if I still had something, bad that happened and I needed the money quickly, I could probably at least break even at the very least. Right. So I'm buying in such a way that if it's not an up market and it's actually the opposite, something bad happens, now I have the equity built in. I'm insulating myself. It's a margin of safety. That's all it is. And so why take a chance on appreciation? You're speculating at that point. I don't buy houses to speculate. I buy houses to win and make that money long term. So it's just a different mindset. But if you have that mindset, dude, this is one of the fastest ways to make, to build wealth really fast. And so that's why I tell people, hey, that difference, like you said, that little difference can make all the difference in the world, and it protects you on the downside in the event of a down market.
I love it. That's awesome. Jeremy, thank you so much. I am learning so much and I'm so excited about it. And I know other folks are learning a lot here too. And I really, after all of these conversations, I'm kind of itching to get into something. So I'm still trying to figure that out, but I'm excited. For everyone listening, be sure to subscribe, listen to all the episodes we have. We've got a lot of good stuff out there, and let us know if you've got any ideas for topics, any questions you'd have for Jeremy to talk about. We'd love to hear from you. Thanks so much for watching. And as always, I can't wait to see where your dreams will take you.